We're 1 week into the new tax year and all the changes that took place at the 6th of April. So we want to continue this theme and look at potential strategies for the coming year. I first came across this quote many years ago, but I find that it's quite apt when dealing with tax. Whatever we decide, whatever we plan, things could go wrong, and George Osborne could be the source of it. It would not be the first time that a Chancellor has introduced reliefs and then turned around a year or two later and said that people were using them in the wrong way and therefore withdrew them again. I'm not sure if that says more about us or about the people who draft the legislation. Anyway, my comments this week are directed at owner-directors of small family companies, who are the ones who've been hardest hit by the new rules. And for those of you in this position, I have a question for you. How much could you receive from your company in 2016-17 and pay no tax? The answer is £21,000. Now, not everybody will be able to benefit from this, but let's look at some basic principles. The personal allowance is £11,000. The starter rate for savings is the first £5,000 above the personal allowance limit. When it comes to dividends, everybody's entitled to the first £5,000 of dividends at a tax rate of 0% in any tax year, irrespective of their marginal tax rate. Let's go back and have a closer look at the starter rate of savings income. This was originally introduced to help people on low incomes who were dependent on their savings income for their living. So the £5,000 is intact as long as their non-savings income is covered by their personal allowances, but reduced for every pound that the non-savings income exceeds these allowances. Let's now turn to the income that you can draw from your company. When it comes to a salary from your company, many of you will be receiving a salary of just over £8,000 a year. This is dictated by the primary threshold for national insurance and has not increased this year, so I'm not going to get a pay rise. However, you can be paid interest on any money you have lent to your company. This might have arisen when you incorporated your business, or it might be from cash that you've injected into the business over the years. I have seen suggestions that the unsecured loan interest rate should be between 6 and 10%, but remember you've got to deduct tax at source. So here is a strategy which you might like to consider. Pay a salary of £8,060, pay interest of up to £7,940, and then pay a dividend of £5,000. This £21,000 you pay no tax on. Now, one thing to remember is that this is per owner-director. So if it's a husband and wife company, then each one can draw £21,000, making £42,000 in total. Unfortunately, the company will only get tax relief on £16,000 because the dividend does not attract tax relief. But the savings and tax on the interest is just under £1,600. You should also consider transferring some of your shares to your spouse or children, although they need to be over 18, but it is a way of paying dividends to children away at university, which is a very tax-efficient way of supporting them. Now, always remember that share transfers are permanent. You need to consider any possible implications of capital gains tax and also for student loan repayments if you're using dividends to support your children at university. So here are some interesting strategies which you can consider applying in the current year, but my advice will always be to take advice before you actually take action, in case you end up with an unexpected tax bill. I'm Alan Long from the Long Partnership, making life less taxing.